Hey everybody, this is Jose Blasco here. We are about to get started. As always, sound check. Quick message on the chat box. We do a quick hello to everybody in the room with us. Would be not only polite, but also let me know that we are all connected, sound is good, and we are ready to get started. So please go ahead and type a quick message on the chat box. I will be turning on my video stream as we speak, so I can say hello from the bottom right corner, as I always do. That's my place on the screen, isn't it? And that way we start in 13 seconds, perfectly on time, with that sound confirmation, which I appreciate very much. Thank you so much, guys. Very nice. Perfect. Okay, almost there. 1 second to go. Here we go. Time to begin. We are live, everybody. Welcome to the session, April 8, 2021. This is Options with Options, Trade with UFOs, ready to attack the market with a series of option strategies, a series of adapted approaches to trading depending on the market conditions, and always religiously disciplined, following our rules without deviating from the rules, keeping those human emotions under control so we can produce consistent action leading into consistent result. That's the plan. That's what you would do in all professions, and trading could be a hobby, but definitely it's better to approach it seriously instead of just like, let's see what happens, isn't it? So the idea is to approach it professionally, no matter if you trade with a large account, a small account, whatever it is that you do, just apply yourself, because then it's worth it. Okay. How are you, Ahmed, Christian, everyone? It's good to see you guys. I always say hi to the ones of you watching this video recorded at the end. Today, I guess I'll say it at the beginning. How are you, everyone? If you're watching this recorded, welcome to the session 2. And we begin with a disclaimer here, upper left side of the screen. The disclaimer is being highlighted. Please read it carefully. Do not skip it. Read every word of it. I am counting on you to do so, since it is indeed important information. So please read it carefully. Very good. Plan for today, as always, we just said hello. I want to remind everybody we are simulcasting. This has multiple implications. Number one, video lag. Depending on where you are, we may have a little bit of video lag. The best thing, to be honest, is that there are times where I'm showing my computer clock, so then you can compare my time and your time, and then if you are 10 seconds behind me or 20 seconds behind me, you can measure it and know exactly where you are. Okay. Other implications are the fact that we are simulcasting in public and private environments. We have our private room inside our website, tradewithufos.com/live. That's where the training takes place. But also, we are opening up to the world in places such as YouTube, Facebook, and so on, so you guys can be supported by us as well. Now, of course, we are basically doing private and public streams, kind of like to get our coaching organized for two different groups of you, which is the ones of you looking at trading, let's say more as a part-time thing, or you are less intense about it. And then the second group is more like the people that you are like me, like always want more, never got enough, love it, huge passion, very committed. So that's the second group. And for that second group, the recommendation is obvious. You should be in our private room. You should be registered as a coaching member, if you wish, so you have access to the private room, because there the duration of the sessions is beginning to the end with no interruptions. So it's full duration sessions, and you got more of the same, but it's more. So again, if you are looking at trading as something very important to you, that's my recommendation. If you're looking at trading like something like, as I said, more part-time and so on, you don't need to subscribe. You just attend the sessions in the YouTube channel or Facebook, or the Facebook pages, and I guess you're good to go. Just know the sessions will be kind of half the duration, about 30 minutes. Okay, cool. Joanne, how are you? It's good to see you, Joanne. Very nice. Sandeep, how are you? Very nice to see you all, everybody. So anyway, let's begin. We're going to look at the market, review the trades that we have, and look for new opportunities. Okay, the time spent reviewing the trades today will be limited compared to yesterday. Yesterday we were quite intense on managing the trades that we have, so today we should be able to keep it a bit shorter. I will be reviewing with a bit more intensity AFL. Christian, that's for you, my friend. we'll go over that. But again, when it comes to Facebook, to be honest, there is little to be said. Okay, but let's begin with the market. So what's happening in the market? The market is moving up. Okay, is it a surprise? No, we talked about it yesterday. Okay, but what's happening? We are now reaching candle number 8 out of 9. So we may be getting close to the end of this climate, and we may get to see some sort of a correction, a retracement anytime soon. And by the way, notice as well, which is kind of like, reinforcing what I just said, which is basically reading statistics, but something that is kind of making those statistics to have a higher chance of becoming a reality is the fact that, there is no green UFO here. Okay, anywhere close to price, no other UFO form. The nearest UFO is all the way around 400. So, it's, very possible, I would say quite likely, that when the market changes climate from blue to red, we're going to see the S&P fall down all the way to the 400 mark to then maybe resume and continue with a new up climate for another nine candles. Okay, so we'll see what the statistics are at that time. The VIX, if the market is going up by 0.29%, what would you expect the VIX to do? To our surprise, the VIX is up just by a little bit, 0.58%. So while the market is going up, the VIX is going up, which denotes that many people out there are thinking the way I just expressed, which is some people are now starting to feel that, hey, I'm not so confident the market will keep making all times high unless there is some sort of a pause first. Okay, how are you, Maka? Good to see you. So you can see that with the VIX. In any case, it's not significant. It's 0.6%, so it's very little. But you would expect the VIX to go down with the market going up, right? So a little bit of a divergence there that definitely has some meaning. So what is happening to our Facebook trade? Okay, so yesterday we talked about this trade to really look like it's not going to be a good end of the story. Okay. At the same time, the one thing that was in our favor is the fact that the climate is pointing at 8 out of 6, meaning that the climate on Facebook is exhausted. The climate on the S&P is close to exhausted. So if the market and Facebook were to come back down to our blue area, guess what? We will end up with a profit on the trade. But realistically, the blue area is very small. And as I said yesterday, the fact that we have a green UFO there, it's basically suggesting that if price comes back to the blue zone, very likely it will continue going back higher, and therefore this trade it's probably end up as a losing trade, as we said before, even though we really worked on diminishing the size of that loss, which is about 150 now. Okay, based on what we saw yesterday. I won't go through the math given the fact that we did yesterday. Okay, now with AFL. Okay, so what we have with AFL, it's a bit different. Okay, so if I was to look at the risk profile, okay, so yesterday we did a roll on AFL. Okay, I will bring in Thinkorswim as well, so you can see what we have in the account at this moment in time. Okay, so you can see in the account at this moment in time, we have the 30th of April expiration 52 put combined with the 16th of April expiration 52 put. Yesterday we had the 9th of April expiration and we roll it to be the 16th of April. Okay, we did that roll yesterday. Okay, and what that did to us yesterday by rolling, okay, here FL, is that basically it puts us in a position where now the net cost of this trade was $54. So the most you can lose is 54. Okay, that's the most you can lose is 54. If you were to compare this trade with the one with Philip Morris that we discussed, that we decided to not to roll, okay, the difference with this trade is that here's the current value. Okay, we are up $1 on this trade. Okay, so basically breaking even at this moment in time. But the difference with this trade and Philip Morris is that the blue line is above the gray line. In other words, we have positive theta while we are waiting for the earnings report to approach in dates, and therefore potentially, very likely, I would say, the implied volatility to rise, and then the whole structure of this horizontal spread will move up. Okay, the whole structure will move up, providing us with a nice profit. Of course, we are still waiting for this to happen, so we are still playing patience. Okay, and we need to make sure that this is the case. Okay. Now, Ahmed, I read your email. I responded to you as well. I'm guessing that you saw my response. I am not sure, but I would like to confirm with you if in your simulation, in the bottom part of the screen, okay, you have the price of that horizontal spread to be $54. Because look what happens. If I was to enter, which I think is what's happening, okay, in your case, okay, but let me do this. So if I analyze and buy, okay, I just wanted to use analyze and buy. Okay, yes, of course, it's too short of an expression date. Let me pick the 30th of April. If I analyze and buy a calendar, here we go, that's what I wanted to do, right? And I set up the two, the one above and the one below, with the same values, and I do April 30 to buy and April 16 to sell, and I was to use the 52 puts. So, well, it's kind of like a coincidence at this moment in time, but the value that you would get, the midpoint of the value is 55, which is almost 54, okay, and the risk profile you would get is this one, okay. The one I have, okay, is the one above, which has a little bit of a price improvement, which is $54, okay, which is the result of the initial cost of the trade plus all the rolls that we have been doing. So I'm not sure in your case, Ahmed, I was under the impression that when I saw your screenshot, you have added individual units here in the bottom part, and the individual units that you have added show the current price instead of the benefit that you have already accumulated by doing the multiple rolls we have done. So you did not discount that, I believe, and that's why the risk profile was probably not the same, okay? So take a look at that, because when you send me your screenshot, you had, all of those bottom parts that were kind of compressed. So I will not be able to see exactly what you got under, okay? So I'm not fully sure, but if your risk profile doesn't show like mine, well, then probably it's because, again, you're using the real-time price instead of locking the price here of the real executions that you got, netting the prior profits already collected, okay? So, yeah, so hopefully this makes sense, okay? Cool. Let me know, Ahmed, if it's not the case, okay? And also for you, Christian, hopefully this explanation makes sense. Yesterday we concluded, yeah, definitely, if it was worth to roll yesterday, it is even more worth to roll today. Actually, the word will not be worth, it's actually urgent to roll, because yesterday we already saw those distorted Greeks. So if you don't do it today, you're going to be exposed to even more distorted Greeks, putting on the side that, and then on Friday, you're going to be now, when the market closes on Friday, you're going to be left with a naked put instead of a horizontal spread, okay? So, yeah, so notice April 9 has extrinsic value of 4 cents with a theta of 5, okay? So notice that the theta is more than the extrinsic value, cannot be, okay? So we are talking about distorted Greeks, and therefore you want to go for April 16, which will provide you 27 cents of extrinsic value with a theta of 3, okay? So definitely you want to move into the next expiration month, okay? And again, good to do it, because that would provide you with positive theta, given the fact that the gray line is below the blue line, okay? You don't know why the diagram looks different, okay? Okay, so maybe, Ahmed, what you could do is the same thing that we had Mark do yesterday. Let me send you a link, and if you don't mind, okay, just keep in mind that if you use that link, we will get to see your whole screen, okay? So just make sure that whatever you don't want to be seen, you take it out of your screen, okay? But you could use that URL that I'm posting on the chat box, which is a website called snipboard.io, and you can take a screenshot of your screen and then copy paste the resulting link on the chat box, and therefore I will be able to see the exact risk profile graph that you have now as we speak, and I will be able to compare that, okay? So if you want to do that, go for it, okay? And in your case, Christian, the answer is again yes. It would be time to roll, given all the reasons I have explained today. Okay, cool. So let's continue. Today we're going to start looking for non-directional trades. The type of non-directional trades we're going to look for are going to be iron condors. I was going to do that yesterday. In the end, it didn't work. So I'm going to try again today. My scanner is looking at top instead of bottom. So I'm looking at high prices for options, and therefore I want to sell them. So I'm going to do iron condors. Then because the VIX is very low, so if I don't find any opportunity, I will certainly be delighted to then look at diagonals or double diagonals or double calendars and look at those other possibilities too. Because right now I got AFL and Facebook. One is positive vega, one is negative vega. So they kind of offset each other. So I need trades of all types. Okay, I don't need to stop myself from not trading something. Now, being directional is something that I'm not too keen on today because we are reaching the end of a climate. And, betting to the downside is too soon. I don't have the evidence. And betting to the upside is maybe too hopeful because statistics suggest the climate will end soon. So again, I'm going to be working on the non-directional trades, okay, to just keep adding odds of success in my account. And when the time is right to do a directional trade, of course we do it. We love it. But it doesn't seem to be the right time at this moment in time, okay? So what I'm going to do is sort all those stocks using the price. Goldman Sachs, actually, I checked yesterday, you may remember, so I'm going to skip it. Earnings were very close, 414. So the only way to do this trade would be using 409, which is tomorrow expiration. And the UFOs were too far away, if you remember yesterday. So I'm going to start today with Alibaba and see if this one will provide a better setup for the trade. So far, not a good news because we got 44%. So that's not good enough. What if I look at pre and post market? 1, 2, 3. It's 46%. It's actually better, but it's not good enough. We need 48. Okay, so we're going to move to Novavax and see what we got there. With pre and post market is 44%. With regular session, it's 47, 48. It's almost what we need, but it's not what we need. So we don't improvise. What about Pepsi Cola? Okay, well, Pepsi Cola, like Coca-Cola, are some of those stocks that, similar to utility companies such as Verizon, T-Mobile, and so on, they often have extremely little premium built in. Okay, so even though we got 63%, okay, which is incredible performance for a stock. Okay, we see that in futures and forex. We normally don't see that on stocks. I mean, that shows you huge, massive institutional interest. Okay. But again, if the premiums are going to be so low, so not sure it's going to work. Okay, so let me see. So about to make all times high with Pepsi, only one red UFO. What if I look at pre and post market? Still one UFO. Probabilities are not good enough. So again, I cannot do a trade on Pepsi because I only have one red UFO. And in order to be non-directional, I need at least 2 red UFOs, at least 2 green UFOs, okay? So I'm gonna move to Morgan Stanley and see if that one will give us what we need. Actually, earnings are on the 16th, okay, which is next Friday. So we cannot use next Friday, but we need to use the 9. So I'm just gonna skip it, okay? Even though, well, maybe I'll try. I thought it was a cheaper stock, to be honest. I don't know why I thought Morgan Stanley was a bit cheaper. $79 is not like it's very expensive, but maybe. Okay, so let's go. Let's give it a try. So pre and post market, 46. So that we skip regular session data, 48.62, which is 48 or more. So we can certainly go ahead and use that. Again, this is going to be an aggressive trade. The beauty of doing a 1 day and a half iron condor is that if it works, if it meets our rules, the probability of profit is going to be humongous. The problem is that the probability of meeting our rules is going to be very low, meaning that probably is not going to work and we will not accept the trade. And the other thing is that if we were to accept the trade, the downside is that there is no opportunity here to do any sort of tweak or conversion from iron condor to iron butterfly because it's a 1 day trade. Okay, so it's either you're right or you're wrong, and that's it. Okay, so we're going to take a look just in case. Knowing that the advantage is great, but the disadvantages are, there, and probably they will make it impossible for this trade to work. So if I was to look at two UFOs above, that's already pointing at 82. So 82, if I look at the price of calls at 82, they are trading at 5 cents. So obviously we cannot sell those because we only sell options when they sell at 35 cents or more. Okay, so no trade on Morgan Stanley, which is what I told you most of the times. It doesn't work. Okay, it's always worth it to check though, just in case. So Tyson Foods, let's wait for this to be fully loaded. If I look at the monthly time frame, we are not making all times high. So the last time we were there, it was about September 19. So I may have to load more data. We have good probabilities, okay? I don't see red UFOs, but they should be. Okay, so I need to load data starting, what's the date I just said? It was 2019, but I forgot the month. Yeah, 10. Okay, 9 or 10. We'll start with 10. So I'm gonna go ahead and add data starting October 2019. This is gonna take a little bit of time to load. Notice how now we can see some UFOs above price, okay? So there are a bunch, and probability is still very good, 54%. So definitely this is something that will allow us at least to work on it and see if we can make a trade to happen. Earnings are happening on May 3. Okay, so May 3 is right there, meaning that we can use expiration dates up to April 30. So 30, 23rd, or 16. Okay, so let's begin with loading the option chain to see what we have. This is not the most liquid stock in the world. So the first question is even, do we have weeklies here? And we do. Okay, so these allow us to use 16, 23, 30. So we'll start with 16, precisely because I just said it's not the most liquid stock in the world. Using the monthly expiration date would help us to find a bit more liquidity. So let's see if we can find what we need with April 16. If not, we can always move to April 23 or April 30 and see if the trade can be accepted using those further out dates. So +1 standard deviation and -1 standard deviation is 78.5 and 73.5. So let's draw the lines. Okay, 1 and 2. Okay, and I just said 73.5 and 78.5. So 73.5 and 78.5, something like that. Okay, so basically this means that we need to use, we need at least 2 UFOs above, and we have them, but then we need the UFO to be beyond the dotted line, so that would be the UFO. And if I was to calculate, from the current price to that upper line, what's the vertical distance, and I was to project that below, right, from the current price, so it would be something like that, and that, as you can see, would bring me to here, which is basically forcing me to go to that second bottom UFO. Okay, and again, if I was to look at the distance to that second bottom UFO, just to try to put myself in the middle of the range as I start the trade, and I was to project this above, so I guess you are with me that probably a better setup will be to use 83.5 to 63.75. That allow us to start a bit more centered in the range. Okay, now something I didn't check is pre and post market data. So we got 54% with regular data. We got 41% with pre-post market, so that's irrelevant. So it's not useful, so we're gonna ignore. And therefore, this is the range that we would be trading. So, I mean, using April 16, I would anticipate the 83.5 to pay nothing because it's kind of like 2 standard deviation. So 53.5. Let's see how much that one paid. Sorry, 83.5. Not sure why I said 53. So notice that the 82 is already paying 5 cents only. So yeah, no way we can do April 2016. What about the 23rd? The 23rd, we are being paid just 11 cents, still very little. What about April 30? So no, it's not working either. Okay, not working either. So there is not enough premium built in those options. Okay, and yeah, the price of the stock, it's $75. It's not a cheap stock. It's not an expensive, so that's not helping. But the fact that the VIX went down is really what's crushing the prices of options at this moment in time. So we're gonna have to discard it, even though the setup looked very good, but is not good enough from a point of view of the premium received. Okay, so we cannot do this trade. How is it going so far, everybody? You guys give me some feedback if that's okay, just to make sure that everybody's following. So with CVS, which is the next one in line, we have 58%. That's very good. If we look at pre and post market, it becomes 47.6, which is not as good as what we need. We need at least 48. So we'll stick with regular session data. Problem is that we do have two UFOs above and below. Okay, we do have two UFOs above and below. Okay, but if you were to calculate the midpoint of this range, right? So 76.47 plus 69.22, when you were to divide this by 2, that puts you at 72.84, which is kind of like $1 lower than where we are. Okay, it's somewhere here, more or less here. Okay, so it's kind of like $1 lower than where we are. So in a perfect world, you will want to see CVS to fall a bit more before entering this trade. So then you get the maximum statistical advantage by starting in the very midpoint of the range. Thanks for confirming, Joanne. That's very nice. Everyone, don't be shy, guys. And again, it's so appreciated when you guys get back to us and confirm that all is good. Because if it's not good, you have to say it. You need to speak up, my friends, because I cannot guess it. If we at least we were to be in the same physical location, I would get to see you, and maybe your body language or something would reveal that I'm going too fast or whatever. But in an online environment, you guys need to be collaborative and be on top of those chat boxes, and don't be shy, okay, guys? And if you happen to be shy, just make up a name when you log in, because you can make your name to be whatever you want, isn't it? So just pick up a name so no one knows you, but when you are in the room, go ahead and participate, guys. It's going to be better for you and for the session and everyone else, actually, because now we all learn from each other, okay? Cool, thanks for that. Anyway, so CVS, not super ideal because of not being in the very center part, and therefore I'm going to leave it alone, okay? And what I'm going to do is I'm going to get the scanner to rescan, now looking for low volatility opportunities. So instead of top, I'm going to move this to bottom and restart the scan. Okay, and now we're going to be looking for opportunities to do either diagonals, let me rephrase that, horizontals, or double horizontals or double calendars, which is the same thing. Okay, so we're gonna be looking at that the moment the scanner completes the analysis. Okay, out of curiosity, I would like to know how much we would get paid if we were to trade CVS options. So CVS 76.5. So how much do we get paid there? CVS 76.5, 2305 roll. We will need to go all the way to April 30 to get our 38 cents. Okay, we will need to go all the way there. And if we were to use April 30, a 1 standard deviation projection would bring us up to where? So 1 standard deviation last minus 1 standard deviation, that is 77 and 70, and 77 is actually above that. Okay, so yeah, if we don't have the price of that stock to draw by another dollar or so, the trade doesn't work. Okay, it doesn't work not only because we don't have the, let's call it, maximum statistical advantage by starting in the middle part, but on top of that, the upper statistics is pointing at 77, which is beyond 76.43, and therefore the trade would not be acceptable because we cannot use shorter expiration dates given the fact that we don't get our 35 cents. Okay, so in other words, this may be homework for you guys. Keep CVS in the radar. If the market was to push down, I mean, CVS was trading 1% negative and now is 1.17% negative. So if a little bit of additional fear kicks in, and there is no green UFO until 70.74, right? So if a little bit of fear kicks in, it could be an easy thing for this to be down by 2% before the end of the day. Okay, easy. So just watch it, okay, because maybe after the session is over, maybe 1 hour later, you do have CVS trading around 72.8, which is more or less the midpoint of the range, and now you can go ahead and plan the trade and execute a trade that would be valid then, okay, but not at this moment in time. Cool. Okay, so scanning. Let's see if the scanner finishes quickly so we can begin with the planning. Okay, guys? Very good. And as we're waiting as well, I would love it, guys, apart from you guys sharing if all is good or not. I would also like you guys to share. We've been running now for almost a month and a half, a little less than a month and a half. We've been running double the amount of option sessions, and also we've been getting a bit more intense with the content and more advanced. So I'd like to know how you feel, especially if you were attending our sessions before and now you see the difference with the current sessions. I would really like if you guys were open to share how's it going so far. If the differences we have implemented, you feel they are in the right direction and the new sessions are helping you greatly, or maybe no, maybe while we are more advanced, we are too complicated, or I don't know, anything that maybe I didn't think about, but you feel it as a negative thing. So I would love you guys to go ahead and phrase it so we can help better. Okay, cool. Almost there. Okay. And by the way, Ahmed, I'm not sure if you were able to look into that diagram because I didn't see any URL sent by you, so I'm not sure if maybe you were able to fix it. Okay. Anyway, I think I just clicked in the wrong place. So let me sort again the prices of those stocks from top to bottom. We're gonna start with Baba. Again, Alibaba, we talked about it earlier, is not 48%. So what about COF? Joanne, you are new and you like the speed. Okay, that means that you like, when you're driving your car, you like to speed and you happen to be new to trade options, or you mean that you happen to be new to trade options but you like the speed of the sessions. This is again, I guess it's the contagious bad humor I had yesterday is being contagious into today's session. Sorry for that, Joanne. That was a very bad joke. Anyway, I know you are a very good driver. Ahmed, we're lucky to have you teaching us and coaching us. Thank you so much, Ahmed. That means a lot. Really, it really means. So anyway, so with COF, we got 45%. That is not good enough. If we switch to pre and post market, that would be 37%. That is not good enough either. So we're gonna move to FISV, okay, and see what's happening with this trade, with this market. So pending data, it's loading. Earnings on the 27th of April, 54%. All of this is good. I see no UFOs anywhere close by. So my hope is that pre and post market will fix it for us. If not, yeah, no UFOs. The UFOs on the pre and post market are only 32%. And the UFOs that we find in the regular session data are so far away. So we cannot do a trade on that particular stock. So Merck, what do we have here with Merck? So with Merck, we got very good probability. Earnings on the 29. Pre and post market provide what? Provide 45. So that's not good, but regular session is good. And we got plenty of UFOs above and below. Okay. So definitely, we are ready to go. Luis can comment on that. You mean the speed of driving or the speed of skiing? That's another one that we could discuss, isn't it? So, very good. So let's focus on Merck. Again, remember when building the calendar spreads, okay, which again, if I get you confused at times, I don't mean it, but in the industry, it's a normal thing to call calendar spreads, horizontal spreads, or time spreads. So you will see me or you will hear me use those terms interchangeably. So, so don't get confused, okay? But again, when doing calendar spreads, what's very important is to make sure that the expiration you buy lines up well with the earnings date, because typically you would have this increase of premium, as we've discussed before, as earnings approach, but that affects way more intensively the expiration date that is lining up with earnings. Okay, so that would be April 29, that's going to be April 30. Okay, and when we look at April 30, which is right here, what do we see? Well, we see implied volatility of 21. Okay, the next one is 19. So I'm not a super lover of what I see, because I like to see better premiums in the front weeks, so I can have what I call this arbitrage opportunity we discussed before, where you sell premium that you sell options that got more premium built in, given their implied volatility. And therefore, when I see that, I'm not a lover of doing it, because it puts you at a slight disadvantage. Now, you could argue that the disadvantage here is like 2%, so it's not a big deal. But at the same time, 2% here and there at the end of the year, it is indeed a big deal after so many trades executed, and I'm not so happy to do that. We've seen cases of, you see here, for example, 21, and then you see the next expiration date to be 22 or 23, and then you will be like, okay, so for whatever reason, there is more premium built in the future, but the one with the earnings have not exploded yet when it comes to the increase of implied volatility, and therefore I would still be open to do it. But in this case, you can see that there is already some of the pricing, some of the excess of pricing that is related to earnings is already built in April 30 expiration. We can see that clearly because the expiration before and after is less pricey. Okay, so because of that, we're gonna look to see if another stock will be a better candidate, because it's not ideal to start this trade with Merck. Okay, maybe if you did it a few days ago, especially when the VIX was falling hard, maybe yes, but not today. So while it's a pain that you see this beautiful chart and these beautiful UFOs and everything is looking like, okay, yeah, we have it. We need, as traders, we need to be ready to say no, right? Traders, we should discard trades more often than the amount of times we accept trades, because that equals quality. Okay, so that's exactly what we just did. Okay, so we got 52% here with DuPont. Earnings are on May 4. This is a bit further in time, so here with DuPont we may have an opportunity to do what we want to do. So we're going to load DuPont. May 4 would be built in this expiration date, which is May 7. Okay, and here I'm happy to work on that, because if you look at May 7 is 25%, the next one is 25%, the prior one is 27%, and the front week is 27%. So in other words, we have here that arbitrage opportunity I talk about, because of that, the way the premium is distributed so far. The very major, massive problem we have here is a problem with liquidity, where this expiration date is showing terrible, absolutely awful spreads from 31 cents to 2.69. This is absolutely not tradable, absolutely not. And we're going to have to skip it. We're going to have to skip it because, and that may be the reason why, let me see, that may be the reason why the prior expiration date got more premium built in. Still very bad liquidity. So yeah, I'm not sure. Out of curiosity, I will check the front month. Yeah, the monthly is much more reasonable, even though it's not amazing, but much more reasonable. But the weekly expiration dates are absolutely awful, as you can see. So yeah, so we're gonna pass on DuPont, even though the chart, showing all those UFOs above and below would potentially have given us very good opportunities. Okay, but yeah, we don't, so we pass. Okay, Comcast, many green UFOs, only one red. So that's not good. Let's see if we can load the pre and post market and discover more. Yeah, there are more UFOs now, but they are not 48%. Almost, but it's not. So we're going to pass. We go for the next one, MPC. We got 42%. That's not good. What about regular session? Well, actually, I was not patient enough. I did not load the whole thing. So we got 51%. Oh, that huge open gap to the next UFOs below. It's basically killing the setup because then the range would be so wide. Yeah, 42%. So not good. So the last one in the list, my friends, is Coca-Cola. Sometimes, there are days where no time to trade, and if that's the case, then that's the case. Again, it will be a bit painful that we end up spending all this time looking at charts and we don't have any valid setup. Okay, look at that. With Coca-Cola, we have a similar setup where the next UFO is so far down that that would really not work. And so the last time we made all times high, that was in January 20. Okay, so let me see if we got more red UFOs above. Now, in any case, I'm not going to do it because earnings are on the 19th of April, which is way too close, and we won't be able to do our rolls on Coca-Cola if we do the horizontal spread, right? So take a look at that. We already got 21% in exchange for 16. So again, the dates are too close. The implied volatility already started rising. Basically, we are late to the party, and on top of that, this range would not be tradable given the fact that the next UFO is so far down. So we are certainly not. If this is the top and this is the bottom of the range, the current price is here. We are way too close to the top and certainly not close to the middle part. We don't need to be exactly in the middle part, but again, it's a very bad starting point to start too imbalanced. So no trade in this particular case, both for iron condors as well as either double calendars or double diagonals or calendars. Okay, so no trades. Okay, no trade today in that sense. So the only thing that we got left is to go ahead and plan for directional trades. And I have a few here that would be valid for shorting purposes, a few more here that would be valid for buying purposes. Again, I need to add a note of caution, okay, which is the fact that the S&P is making all-time high. That's amazingly beautiful to see, but the climate is reaching its end based on statistics. So it's really not the best time to do directional trades because the climate is more likely going to reverse than stay the way it is, and betting on the downside is not, is a bit too soon. We don't have the evidence. We've seen cases where the market was supposed to turn based on statistics and it just kept going and going. Okay, there is this saying in Wall Street that says that the market may remain irrational longer than you could remain solvent, and I believe that's the exact words. Okay, maybe I just made up a little bit some of the words, but definitely that's the meaning. Okay, so you need to make sure that you are always realistic and never hopeful, and when the market gives you a surprise, make sure that you have risk management in place so you never get hurt. And if the surprise means that the profit is greater than what you expected, so well, great, you'll take it. But we are not going to enter the market out of hope, expecting it to go to the moon, even though we've seen it before. Well, because statistics tell you that the climate is more likely going to reverse than stay. Okay. Ahmed, I scanned for a debit before and I got good trade and I shared on Discord. It worked good. Nice one. Good to hear, Ahmed, that you did that. That's very kind of you as well. So anyway, so let's go ahead and work on the setups, because my anticipation is that in the days to come, the market will turn. So maybe what we can do is we can look at some of the symbols that we have here on the shorting list, okay, such as ABBB, okay, and see if there is any opportunity for us to take a trade, okay. Actually, we don't with this particular one because while the climate is 3 out of 6, and that would be good for us to short, we are trading above the reference price, which is 106, and there is no red UFO until we get to kind of 107 or 107 something. So no trade on ABBV. What about CVX? So we're gonna wait for the chart to load. The climate is good for CVX, okay? Okay, I guess that it was still loading. Okay, now we got it. So we got 52%. So 52% is definitely acceptable. Remember, for directional trades, we need at least 50%. So all of this is good. The climate is showing 3 out of 8. So this is the beginning of a down climate. And the reference value for us to take a trade is 104.48. And at 104.48, not only we have one, we actually have 2 UFOs. Definitely, that's a good entry point. Okay, so my friends, we do have a trade. We're gonna plan it, and we just suggest that you take it easy with position size, especially given the fact that the climate in the market is up. Okay, so we are shorting. So again, this is something that I would do if I had long positions running in my account already, and I was to enter this trade as a hedge against my long trades in case the climate was to change, like statistics suggest. So I would not mind to lose on this trade because that means the other trades will profit. So it would be like a hedge. Now, if you're going to enter this trade by itself, well, still okay to do it if we meet the rules, but at the same time, take it easy with position size because we are not trading futures or Forex here. We're trading stocks, and we know stocks are fragile by definition, meaning that they depend a lot on external factors, such as what is the S&P doing, okay? So let's go for it. Let's go for it. So sessions, I want to see pre and post market. We have 48%, that's not good, okay? It's good for non-directional, but it's not good for directional. For directional, we need at least 50, okay? So we got 52%, and that's what we are going to trade. So let me bring in CVX. Let me begin with the planning of the trade. And the first part of the planning of the trade, and now that I know I have the right climate, the reference value for my entry lines up with UFOs. So now that I know all of this is true, and therefore I have a trade, so I'm gonna start with looking for where the target should be. And that I'm gonna do it in a daily time frame, enabling AutoUFOs to find out where my target would be, okay? And it seems that the target is not too far, which is good, okay? And you will be like, good, why is that good? Well, it's good because earnings are on April 30, meaning that before that we need to be out. So we got just a few weeks to be on this trade. This is not a long-term investment or anything like that. So I rather have a short target, okay, a close target, I should say. So I get there quickly and then I'm out, okay? So 101.06, that would be the location for the target, which is the top part of the UFO, as you can see, 101.06, okay? So that's where the target would be. Okay, I'm just clicking on the wrong place, funnily enough. Like I never used TradeStation before. So 101.06, that would be the location for the target. I'm just gonna type it here. Okay, so 101.06, that would be the location for the target. And the entry, okay, the entry would be that UFO. Okay, that UFO. Why? Because this particular UFO lines up with our reference value on the left, which is 104.47. Okay, so 104.47. Okay, 104.47. It's between 104.06 and 104.57. Okay, so in other words, 104.06, which is the bottom value, this one will qualify as my entry. So 104.06. And it's funny that both got the ending 06. So basically, we are going to catch a $3 move from 104 to 101. That's what the trade is going to do for us, if right. So now, how can we do this trade? Okay. Well, there are multiple alternatives. Okay. But the first thing I need to make sure is that if the distance between entry and target is $3, I use an expiration date that allows me to make at least $3. Okay. And one super quick, easy way on how to look at that is to look at the expected move based on the implied volatility built in the options. Okay, so if you were to use the front week that expires tomorrow, that is supposed to allow you to catch maximum $1.70. If you were to use the next week, that could pay you up to $3.83 based on the implied volatility, which again is just an estimation. So in other words, if my target is $3 away and the next expiration date allows me for a $3.83 move, so that expiration date is good enough for me to use for the trade. Okay, so that's one way for you to decide I'm going to use April 16. But at the same time, we have another rule on top of this rule, which is we like to buy options that line up with the earnings date. Because if that market, was to come to the UFO, and instead of move down $3 and reach your target, and that's it, if instead of that, the market was to come and do something like that, and then come back and do something like that, and finally the market was to come up, hit the next UFO, and then go like that, and then go back up, and then go down, and then another UFO forms, and now it starts going. And long story short, when you get to your target, it's 2 weeks later, right? So what would happen? Well, the option that you use with 1 week and a half may have expired and you lost the whole thing while you were right. Or even worse, maybe you bought time enough to be in the trade, but time decay is really eroding the profits too much. So by buying the expiration date that lines up with earnings, basically it's a little trick to get a kick of additional implied volatility, enter the trade if it was going to take too long for you to get to your target, because the longer it gets, the closer you are to earnings. And no matter if you reach the target or not, you will have an opportunity to exit for a minimized pain, which could still be a loss, but at least the loss would be less, because the option would have gained value as earnings were approaching, because of the natural effect of earnings generating an expectation, which implies people are buying those options, trying to catch a gap on earnings or something like that. So, in other words, 430 is indeed beyond 416. So 430 is right here, and 430 provides up to $7 move. We only need 3, but definitely we'll want to use that one, to benefit from what I just explained. So we're gonna use April 30. That's one part of my conclusion here. And the second part of my conclusion is which strikes are we gonna buy, and this would obviously depend on what type of strategy you're gonna be running. And I'm gonna give you 3 choices, okay? And we're gonna explore 3 choices and see which one is the best. So choice number 1, you just buy a call. So we're gonna analyze and buy a put, because this is a bearish trade. So we buy a put. So we're gonna analyze what happens if you buy a put. Choice number 2, we're gonna go ahead and analyze what happens if you were to buy a vertical spread. So you buy a put and you sell a put against, and that's a spread. We're gonna see what happens. And choice number 3, we're gonna go ahead and analyze and buy a diagonal spread, which means that you buy a put and you sell a put that belong to 2 different expiration dates. Okay, so we're gonna do that and see what happens. So let's begin by unchecking everything so we don't get confused, and then we can build those 3 trades, and then we can compare so we know which one is best. So if I click single, okay, one of the rules we have is that at entry, which is 104.6, we want the delta to be about 30. Okay, about 30. In this case, is minus 42, which means that this put, it's a bit too high. So I'm going to lower it down to 102, and now it becomes minus 37. I'm going to lower it down to 101, and now it becomes minus 31, and I'm going to say that's good enough. So case number 1, if you were to do the trade on the top, would be to buy one of the April 30 expiration 102 put. Okay, I'll talk more about that later on. Now let's uncheck. Case number 2 is to do a vertical spread. How would you do a vertical spread? Well, using April 30, you would buy a put and you would sell a put. Okay, we have a few conditions though. The put we sell needs to be beyond the target. Okay, and we have the target located at 101 something, right? So we need the put to be 101 or below. So I'm going to make the one I sell to be 100. And then the put we buy needs to be between the entry and the target, somewhere in between. That's where it needs to be, somewhere in between. Now, where exactly? Well, it needs to be in some location where the resulting delta is about 30 and the gamma is positive, which is not always possible, but we need to try that. So let's begin. So if I do 103, 100, I get a delta of minus 15. Okay? So that's not good because we need it to be 30. So what can I do? I can move it up to be 104. And now my delta is 21, which is still not good enough. So what's the issue then? Well, the issue is that the one I'm selling is too close. So instead of 100, I'll make it 99. And now the delta is minus 25. That's better, but still not 30. So I'll make it 98. Now the delta is minus 30, which is good enough. Okay. And on top of that, the gamma at entry and the gamma at target in both cases is positive. So I got the delta to be 30, negative because it's a put, and the gamma is positive both for entry and target, and therefore this second selection is a valid selection for me to do this trade. Okay, so that's case number 2, which is vertical spread using the 104.98 put. I'll come back to this in a bit. What's the third case? Third case is to do a diagonal. A diagonal will be done by buying the 30 of April expiration and selling the 16th of April. Now, am I sure I'm going to sell the 16th of April? Let's take a look. If I look at the 30th of April, this pays 28. The 23rd of April pays, let me rephrase that. The 30th of April have me pay 28. The 23rd of April pays me 25, and the 16th of April also pays me 25. So in other words, I got two choices. I could pick 16 or 23. I'm going to discard 9 because, of course, it expires tomorrow, so there's basically nothing left there. But I could do 23 and 16, and I would be inclined to use 23 if that number 25 was way greater. But because they are about the same, so I'm going to do the 16, and that way I have an opportunity to roll the 16 put to become the 16th of April put to become the 23rd of April put later in time next week. If the market was to move against me, I have an opportunity to get a bit extra premium. So let's do it. Okay, let's simulate that with a more precise manner. We're going to use 30 of April and 16. Okay, and again, the put I sell needs to be at least below my target, and the put I buy needs to be between my entry and my target. So if I do 104, 100, it provides the delta I want more or less. But unfortunately, I got negative gamma, negative gamma. Okay, so I'm going to try to push the one I sell further away to 99. That alleviates the gamma, but it's giving me too much delta. So what I'm going to do is I'm going to push the option I buy lower to reduce the delta. Okay, I'm going to do it again to 102. Now it's minus 28. Okay, and now, to be honest, it's a bit too little, so I'm going to push the 99 to be 98. Okay, and now I get the delta I want. Okay, I get the delta I want. What's the problem though? The problem is that I end up suffering negative gamma at my target. So it seems that there is no way for me to make my gamma at target to be positive unless I move my option very far away. Okay, but now I get a bit too much delta. Okay, to be honest, that's not too bad. I was not expecting it to be that okay, pushing it so far. Yeah, I could take that. I mean, it's not ideal because the gamma is 0 at target, but it's not too bad. Okay, so I could do this. Okay, what's the beauty of doing the diagonal if you do 102.97? Well, the beauty is that as the stock goes down, you make money. But then if you don't get to your target before April 16, then the April 16 97 put expires, and then you can go ahead and sell the April 23 97 put and collect more premium and therefore lower the cost basis of the trade, which would help a lot, especially if the stock has been moving in your favor. The more the stock drops, the more expensive the put. So you could actually end up in a risk-free position by doing that. That's the beauty of doing a diagonal. That's why I'm analyzing if that's going to be the right choice or not. So basically, we got three choices. Okay, let's conclude which one to take, if any. Number one, the simple option with the put. That option will provide you a delta of 38. That option cost 195. So the most you can lose is 195 if you buy it, and it pays you at a rate of 38. That's good. The vertical spread costs you more, 234, and has less delta. Okay, so you would think, why would you even do that? Okay, if the put costs you less and have more delta, so why would you do the vertical spread? Well, one key disadvantage of the put is that the strike selected is 101. In other words, the strike selected is basically what the target is. So in other words, if you get to the target, the put is going to pay you amazing. But let's say the market was to move down but not to reach your target and you had to exit the trade because earnings are approaching, then you will be very disappointed on the profit because this option is out of the money and would stay out of the money the day you exit. So you would be very disappointing. And the problem of this trade, to be honest, is that the target is only $3 away. So that's why this is happening. If the target was to be $10 away, so then the probability of this 101 put to be in the money would be higher. But because the target is so close, even when you reach the target, the option will still be out of the money or at the money. And therefore, you better get there quickly, because if you don't, that option is just going to suffer a major pain when it comes to time decay, where the vertical spread has the main unit located at 104. So as long as you are below 104, you're going to make money on this trade. So it does cost you more and seem to benefit less from price moving. But even if price was to move a little bit, that one will pay you, where the one on top will not pay you unless you get to the target. That's why it's cheaper. Okay, so definitely, if I was to choose between the two, okay, and given the fact that liquidity is pretty okay, I mean, if you think about it, 190 to 203, this is like 13 cents. If you look at 227 to 249, it's like 20 something cents. So again, and it's 2 units instead of 1. So liquidity is pretty reasonable. Okay, so I would certainly go for the vertical spread instead of the single put in this case. If the target was further away, it's a different story. And then the third case, which is the diagonal, well, the diagonal will be just a bit cheaper. Participation is a bit better. But now, on top of that, you got the opportunity to do a roll. So definitely, I feel the diagonal spread in this case would be the better candidate, even though there is a little bit of the same disadvantage that the long put has, which is the fact that in this case, you need to reach at least 102 to be okay. If you don't reach 102, it's a problem because the option will be out of the money. Now, of course, if you don't reach 102 and the 97 put expire, you can roll it by selling the next expiration date, April 23. So you offset a little bit the problem thanks to time decay that the fact that the price of that stock didn't reach 102 generates. Okay, so again, you have a little bit of an offset built in the diagonal, even though the one that is the neatest one from a price movement point of view is the vertical in this case because you're using 104. The diagonal gives you that opportunity to do a roll, and therefore that's going to be my pick for this trade. Okay, so I'm just going to mark it in here. If I check mark this trade, notice again one more time that we are looking at a cost of the trade at entry to be around 181. I mean, the cost that we see here is the cost now, but when the stock goes up, the puts go down. So this trade is going to cost you 180, let's call it $200. So you're going to have $200 of risk per contract in this trade the moment you get filled. Okay, so I'm going to place an order and we will call it the day. So this is a trade for us to execute on CVX. Hopefully it happens today. If not, it's to be reviewed tomorrow. So it's going to be using April 30, using puts. So right click to buy a diagonal spread. So we are using buy the 30, sell the 16, and we said we are buying the 102, we are selling the 97. Here we go. So again, the trade would be 224 if you do it now. Okay. Again, we are not doing it now. So I'm going to click that settings wheel to bring in some additional price conditions. Okay. So I'm going to make this market order, the order, and only if the stock goes above or equal 104.06, which is the red UFO that we had on the screen. So again, just to be very visual, 104.06 is right there. Okay, and this is the price we need to hit for us to activate this trade, for us to be happy to be filled. Okay, we are not executing this trade now. We are waiting for price to go up a little bit, and the moment it hits that red UFO, we are now expecting it to fall to 101, and that's where we collect the profits. Okay, that's the plan. So it's a quick one, and definitely ready for it. So I'm saving my price conditions and confirm and send right here. Review the trade. So we're doing the diagonal, blah, blah, blah. If CVX is above 104.06. So the answer is yes. Send. And now here on my monitor window, you will see CVX order waiting to get filled, which is again depending on the stock itself. Okay. Ahmed, I see your comment about emailing the snapshot. Thank you very much. I will check and get back to you. Thank you so much, Joanne, for sharing, how you felt about, looking at those different possibilities and, what makes sense and what doesn't. Definitely, we'll talk more about those things, by the way, because I had I was assuming that most of the rules are understood. And again, we'll run sessions at times where I'll get a bit more in lecture mode, if you wish, as well. So we talk about the rules and why the rules are the way they are, etc., etc. But again, hopefully today was a good session for you guys. Again, working on opening your eyes, working on giving you the tools, so when we are not running sessions, you can practice on your own and find your own trades and practice and grow and so on. Anyway, everybody, my pleasure as always. You guys take care, everybody out there in the world, in the YouTube channels of the world, in the Facebook pages of the world, and of course in our private room for sure, in our website tradewithufos.com/live. Take care, everybody. See you soon. Bye bye. Keep up the good work. Ciao, everyone.